The Money Show.
Personal Finance with Warren Ingram.
It's time to learn more on personal finance with Warren Ingram. He's the co-founder of Galileo Capital. Today, answering the question, is a balanced portfolio the best investment for most people? Warren, welcome again to The Money Show. Balanced portfolios, usually mutual funds that typically contain a component of stocks and bonds. How do we determine who likes what in that particular portfolio?
So I think the interesting thing to me about it is these are a very old category of funds. And if we look at our retirement funds, most of us, whether we work for a company and we've got a company pension fund or a personal RA, most of our money will be sitting in these kind of balanced funds. And, I think they kind of get ignored quite a lot, especially when the world's getting scary or very good. When things are going well again, we kind of think, gee, why would we put money in these boring old funds, and they're just kind of the middle of the road, plodding along doing nothing. And in fact, they seem to deliver pretty good returns over long periods of time. And as you say, they're fairly typical. They've got about 60 or 65 to sometimes 75% in shares, whether they're South African shares or global shares. And then they've got a bit of exposure to cash and a bit of exposure to property companies, and then the balance in government bonds. But they, to me, end up being the place that most of us should have most of our money most of the time. I think they're kind of almost the unsung hero of the money world.
Now, you've crunched the numbers, Warren, in terms of the growth potential of these particular funds, basing it around 2010. Take us through what the economy looked like then, and when you invested then, how much you'd have today.
So I thought 2010 was a good time because, that was the World Cup year, and, we'd kind of, life was good then. We were the darling of the world, and we had an economy that was growing. It kind of surprised me when I look back. The rand was at R7.38 to the dollar.
Can we go back?
Now at over 8. Yeah. Now you look at that and you go, gee, and today we're at 18 plus. And unemployment at the time, I remember. Unemployment in those days was like it is today. It was kind of a bone of contention and a really sore point. But it was 23%. I think we're over 35 now. And to have a growing economy at that time, reducing unemployment, strong rand, just think about what's kind of happened from the World Cup to now. We've had, the 10 lost years that we've had, we've been downgraded to junk as a country, record load shedding, which is not a record we ever want, grey listing, the looting and the, COVID, all of that. It's been to say it's been a hard 13 years is a pretty accurate statement. And I thought, well, let's just have a look at what would have happened if we'd put 100,000 rand into kind of at the time, the two biggest balanced funds around. And then what happened to the buying power of our money from that time to now. And then, I looked at what was the kind of average money market unit trust. And the reason I did that was when times are rocky and the markets are going down, it's kind of a human thing to say, gee, I should just put my money in cash. At least it never goes down. So I thought, well, that's quite a nice thing. Let's have a look at that as well. And from 2013 to now, if we put 100,000 rand and try to protect it against inflation, our 100,000 rand would now need to be worth just under 200,000, 196,000 rand. You put your money in cash and it never goes down. What happens to that? 13 years later, your 100,000 is worth just under 230,000. It's 228,000 rand. And then I looked at, and we don't need to give them kind of free advertising, but the two big balanced funds that I looked at, they've generated a return of about 363,000 for the one and 367,000 for the other.
And so this is just money that would be funds, growing passively, Warren. You don't have to touch it. You don't have to fiddle with it. It's stuff that you bought at a particular time. Let's say 2010. You have your group of shares and stocks and that you've put in there, a percentage of bonds and property stocks as well, and you leave that for 12 years, and that's how much you would have made.
Exactly right. And no rocket science, no timing the market, not being cleverer than everyone else about when to buy and when to sell. And And you just think about how much time and energy we all spend. I'm doing it every Thursday night, about talking about the markets and where things are going and what's the rand going to do.
There's a
and
lot going
rates,
on.
all of that. Yeah, there's a lot going on and so much noise, and then you just think, wow, like, why do we spend so much energy and especially emotional energy and stress on what our money does when actually, just buying something that's fairly balanced, fairly consistent, and leaving it, you end up, more than kind of nearly, well, not quite. Let me say nearly doubling the buying power of your money. And I think that's the real power of this is actually, we want to protect our capital against inflation. We want to grow faster than that, and not being super clever gets you to that point. Just buying something and holding it for a long period of time. And I didn't go and choose the ones that had done the best. I just chose the two biggest ones at the time. And then, I mean, I have to point it out, and I know I'm being a bit naughty, but these fund managers, they spend millions and millions of rands on branding and marketing, and they do these big TV ads and they tell us how amazing they are and why they're so different and why they're so special. 13 years later, the difference between the two funds works out to be about 4,000 rand, on amounts of over 360,000 rand. And to me, that's nothing. That's not money. I don't know why we spend so much energy even just choosing fund managers. We just need to choose, like kind of consistent managers and be done with it. We can kind of put it in the bottom drawer and forget about it for a decade, and I think we'll be surprised with the result.
And how much would we have to pay for a service like this over the past 12 years that you've been talking about, from 2010 to about 2023? How much are we paying in terms of service costs?
So those funds would typically run you at about 1.5% a year. So it's a good question because I haven't actually done the sums, but while I'm kind of stalling you and trying to work it out quickly, but it would, the important point to point out there is that your 360 plus thousand rand is after costs, because when you buy these balanced funds, the costs are built in already. So you've paid all your fees. The only thing you haven't paid would be our profit share to our beloved SARS, because we would have to pay some capital gains tax when we sell one day. But that's the only other cost. Everything else is already baked into that growth.
And how does somebody buy into a balanced portfolio or this type of fund?
I mean, pretty much all the big mutual fund or unit trust companies, have a direct offering. In other words, you can go onto their website and simply, look for a balanced fund and buy it. And I think just to caution before you do that, make sure you do some homework. I'm talking about a fee of around about 1.5%. So part of the homework you really need to do is look at what you'll see. The jargon for this is total expense ratio or total investment charge. So they'll often talk about TER or TIC, and you want to make sure that the fees that you're going to pay in those funds is not too high. So benchmark yourself at somewhere around 1.5 to maybe a maximum of 2%. If you see a fund, a balanced fund, no matter how good the track record is or how good last week's performance was, if it's charging you kind of 3 or 4% a year, which some of them do, choose another fund is my view, because you can't, in an environment where we're hoping to get 10 or 11% a year, paying away 3 or 4% a year in fees, to me is just ridiculous. That it's not sustainable. So cost is a big issue there. And then, I know there are always new funds coming to the market, and there are always new asset managers, and these asset managers always get really upset because they say no one supports us. We're new. They should look after us. But the point is, when you're putting your money away for the next decade or two, choosing a kind of a biggish team that's got a bit of a history behind it and a proven track record of managing your money in good times and bad times. For me, there's real value in history and a proven track record. So I tend to avoid the newer managers until they've kind of built a track record of at least three years and preferably 5. So maybe that's another good point to consider. But also just know that, when you start your own retirement annuity, for example, or you've got a company retirement fund, just have a look at what's inside those, because often that's also where you've got a balanced fund. So yeah. I'm saying you can buy it as a unit trust, but you could also buy it as an RA.
And a lot of people, would see themselves as having an appetite for risk, and this is too boring. But, as an advantage, do you think every investor should have one?
I think, when we invest our money, we shouldn't be all or nothing with our money. In other words, taking all of your money and putting in the riskiest investment around because you feel that you're a risky investor, that's a great way to lose money. So I think life and money is all about balance, so having a solid chunk of your money in balanced funds, irrespective of your age, I think is a very good call. And then if you're younger and you can deal with big losses, then maybe take another portion of your money and buy something that's, potentially offers better reward. My experience is those things that offer you kind of the highest returns very often come with the other side of that coin, which is, big losses and often that ends in tears. So I think, by all means, have this as the core of your portfolio, and then add a bit more risk if you want. And on the other side of the equation, if you really don't like seeing losses, whether it's over a month or 3 or 4, then maybe you add a bit of a more conservative kind of element to your portfolio, which is a complement to this. But I think if this is the bulk of most people's money, I don't think it's a return we should sneeze at. Just over 10% a year. In the environment we've been in, that's really powerful. And I think, we kind of get too hyped up often, and I think that emotion is really dangerous for us.
I guess the other thing is someone can say, I'm sold, I want a balanced fund, but what exactly do you put in there? What right mix of shares and bonds do you put in there to make sure that you get the returns that you're talking about at over 10%?
So in the unit trust world, balanced funds have real meaning. In other words, they're a category of unit trusts, and it's prescribed already that they're allowed a minimum amount in shares and they're allowed a maximum amount in shares. So you'll find that they'll range. They'll probably at the lowest end, probably not much less than 50% in shares, and at the maximum, I think they're allowed 75 in shares. So you don't have to do much work as an investor. That kind of that mix of the asset types has already been done for you by the balanced fund manager. Your job is really just to look at the overall and just see that the fees are low. They've got a kind of a longish track record. They're fairly consistent. Once that work's done, you're not worrying about how they kind of cut and dice the portfolio. But what you need to know is that the bulk of your money will be in shares, and maybe really importantly is one of the things that Treasury's done a little while ago is that they've changed the amount that balanced funds or all retirement funds can invest overseas, and they've increased that to 45%. So it means now that, you buy a balanced fund, your fund manager's got a massive range of shares that they can choose from within SA, but more importantly, globally as well. And the same with bonds and property, etc. So the world is really your oyster with a fund like that, and you're not losing out now on potential growth. So I think the answer is spend more time researching the balanced fund that you need to buy, and don't worry too much about what the fund managers are buying once they're in. I think that's their job, and that's what they get paid to do. And it's our job as investors to monitor that they're sticking to what they said on the box.
You touched on, Warren, earlier about, sometimes your employer having this balance fund in place already. Can you take a peek and maybe advise that they changed what's in your makeup in terms of the assets in that portfolio?
So this kind of retirement fund world generally, to me, breaks up into two broad categories. There's the one route where the employer says, "Look, we're going to choose, with the trustees of the retirement funds, because especially with bigger companies, employees get to sit on as trustees of the retirement fund as well, and they'll agree, and maybe just say, look, we're going to have one portfolio for all of us." And so, as a member of that retirement fund, you certainly have the rights to look at it, and you can kind of agitate to get yourself voted on as a trustee if you really want to put the work in, and then understand what's going on, and cast your vote to change the portfolio if you want to. The other kind of group is that you'll find a lot of the time they'll offer what's called umbrella funds, where you kind of get a bunch of employers get together and all of them can contribute to one very large group of funds, and often they give you some choice. So you might say, I want to choose the maximum risk I can for a retirement fund, whereas someone else might be so cautious that they'll choose something else. So often you do get a bit of choice with these bigger umbrella funds. But I wouldn't be surprised when you look at the large employers where they've just got, one fund and it's kind of one shoe fits all. And most of the time it's going to look a lot like, one of these very big balanced funds. So I think as long as the fees are low, I wouldn't put too much effort into trying to kind of get that moved. The only thing I would say is, if they're sitting with, the lowest amount in shares all the time, in all market conditions, then I'd get really grumpy because, shares are kind of your engine of growth. And so you do want a large allocation to shares in your balanced fund. And to me, that range is somewhere around 65 to 75% in shares.
You've spoken about this particular model from 2020 to 2023. So about 13 years, you can keep this particular balance fund and make sure you make over 10% in returns. How long can you keep this particular fund? And when it's time to cash in, how much are you looking to pay SARS then?
So I think it's maybe the other way around. You can keep it forever. So I think that it's an ideal vehicle for us to build up our long-term savings. But what I would say is on the other side, the shortest period of time you should plan to invest is probably 5 years. I wouldn't necessarily kind of put my 1 year savings, or if you're saving up for a deposit on a house or a car, and you want to do that in 3 years' time, then maybe a balanced fund isn't for you. But if your time horizon is kind of 5 years or longer, then I think all good. In terms of tax, you're probably, if you pay the most income tax possible in South Africa, and that's important because that will determine how much capital gains tax you're going to pay. The worst capital gains tax you'll pay will be around about 18%. So definitely for people that are building up money and trying to get money to go and work for them, you'd much rather pay capital gains tax than income tax. And that's, for example, what you would pay on a money market fund, because you pay income tax on interest. So I like paying capital gains tax instead of income tax. Although I have to be honest, I hate paying tax when I see what's been done with our tax money. But when we have to, let's pay capital gains tax and not income tax.
Look, you don't want to upset the taxman. And now, when you look at these particular funds, not everybody has the same discipline. So you can take out this fund, you have it for 5 years, you have it for 10 years, but you want to keep it for longer. But there's this itch that's telling you should be withdrawing. Can you speak to the financial advisor to say, look, can you lock me in for 30 years and I'd have to sign a particular contract that I can't touch this money?
About the only way you can really do that, I think, would be if the money was locked into a retirement annuity. If it's a straight sort of standalone unit trust, then unfortunately there isn't really a way to do that. I would love it if that was possible, because I think often we're our own worst enemy. It's often the person in the mirror that's the biggest enemy of our financial freedom. It's the decisions we make. So unfortunately we can't do that. And I think a lot of people listening would be horrified, if we said, no, you can only touch this money again in 30 years. Everyone wants access to the money, or at least to know they can access the money, which is the case with unit trusts. But if it's the other way around and you wanted to lock it away, probably a retirement annuity is your best route, because at least it's locked away until you're 55.
At what price point can I come in? The earliest I can come in. I mean, you've priced it at 100,000 Rand here, but can I come in at 10,000?
Yeah, I think, if we look at debit orders, for example, I think, a lot of the time these companies will accommodate you at sort of 500 Rand a month, So I can't remember the lump sums, but, let's say between 500 to 1,000 Rand a month, or, I think, probably 1,000 to maybe at max 10,000 Rand as a lump sum. So I'm not saying it's perfect for everybody, but it's pretty approachable for most of us in South Africa.
And then, Warren, let's look at now a question that we got from one of our listeners. The letter says here, I've accepted a job offer in Ireland, but I plan to return to South Africa once the contract term is completed. It doesn't mention how long the contract is there. And it says, I have a tax-free savings account and a unit trust. I add to these investments every month. Should I continue adding to my investments or look for something else in Ireland or offshore?
I think it's actually a great question, and a lot of our kind of workers, and are in this kind of a position where they're looking, overseas to work some, part time or maybe full time. And so to me, if the plan is to return, then I definitely want to keep adding to my tax-free savings account, because, the faster you can get your kind of maximum amount in the tax-free account, the better, because, then it gets to grow and compound without paying any tax, not even capital gains tax. So I would feel quite a lot of pressure, if I'm in the listener's shoes, to kind of keep going on the tax-free account. The unit trust, it might be worth pausing that and not adding to it. Don't sell what you've got, just leave it there, and then use the money you were putting into the unit trust to kind of build up an investment overseas. We've just been talking about diversification. So while you're there and you've got the money and you don't have to pay the currency conversion costs, then by all means find a good good balanced fund overseas that you can contribute to, and when you come back, you can leave that over there and it'll continue to grow, and then you can keep going on your tax-free savings account in South Africa. So I'm not convinced that you stop contributing to both, but maybe just the unit trust. If you're earning lots of money over there and you've got some disposable money, then by all means do the tax-free savings account and the unit trust in South Africa, and then something else overseas as well. But I mean, we never know what the earnings will be on a contract like this. But if you're going to have to choose to keep going on the tax-free, I think it's the best thing that SARS has ever given us in the last kind of 10 years, and I think we should take advantage of it.
Just to add on to that particular listener question, in terms of going offshore, what's the easiest way, to take some of your money offshore to try and diversify, as we see what's happening in South Africa?
So I mean, I think I know I've been laboring the point, but don't forget your typical balanced unit trust is probably running at 45% already. So you've got some very nice exposure there. But there are a category of exchange traded funds and unit trusts in South Africa called feeder funds. It's a terrible name, but basically what it means is you're contributing rands to a fund that then invests all of the money overseas. And what's nice about those is that they're really efficient for doing monthly debit orders or smaller lump sums, and you're not paying the banks huge amounts to convert your rands into dollars or into pounds or into euros. So I like feeder funds for debit orders or small lump sums. And then the alternative is, a lot of the big unit trust companies in South Africa and around the world have, a huge range of dollar, pound and euro denominated global funds. And that will be the route if you've got a larger amount, and I think if you've got a huge amount, we're now into the kind of $1 million mark, there are some really good offerings right through Switzerland and all over the place where you can kind of build up a proper portfolio for yourself of investments all around the world.
All right, that was the investment school, the personal finance feature rather, with Warren Ingram, really taking us through our paces, saying if you had put away about 100,000 Rand in 2010, the inflation being at 5.22%, you would have made about 196,000. If you went for a money market fund, that would have been at around 6%. You would have made about 228,000. If you went for the big balance funds, which is what we're talking about today, you would have made over 10% at 363,000. So some key sound advice there coming through from Warren Ingram. It's one of those plans that you can put the money away, close your eyes for the next 10 and 20 years and come back and enjoy some of those returns. Of course, be careful. Do some of your research when you get into some of these funds.